Hey everybody, welcome to this free edition of our weekly roundup. This is for the trading week ending May 2020. Send in the clowns. As you guys know, our trader user group, we don't want you to be a rat brain trader, be the red striped zebra and trade smart. So it's a little bit of a contrarian approach, but historically, statistics show that if you're on the same side of the boat as everybody else, then your returns suffer. And if you take the contrarian approach, then you're going to generally do fairly well in the markets. Okay, so let's go take a look at what happened this week. If we look at the markets, you can see here the index performance really had a strong week. The Dow was up 3.29, S&P up 3.2, NASDAQ up 3.44, the Russell a whopping 7.84%. The only index in the US right now that's above the zero line for the year to date, as you can see here, is NASDAQ. It's up 3.92%. The others are still in the red. And of course, if we look over at the best sector performance, you can see energy up 6.42, and the worst for the week was healthcare at minus 0.56, 56 basis points underwater. And then, of course, if we look at the world index performance, we can look at Europe, the FTSE, the CAC 40, the DAX, they're all up nicely. The DAX was up 5.82%, both the CAC 40, which is Paris, France, and the FTSE, which is in London, both up over 3%, CAC 40 up almost 4%. And then, of course, over in the Asia Pacific area, the Nikkei was the lone survivor there, and it's no surprise that China was down 1.91%, and Hang Seng, which was a Hong Kong index, down about 3.6%, with the surprise announcement this past week with China, basically tightening up what they're going to do over in Hong Kong. More on that in just one second. And then, of course, if we look at valuations, you're going to see that the PE ratio, the trailing 12-month PE ratio, a whopping 25.56, and the forward PE ratio is 23.15. So the forward 12-month guidance is lower by about 9.43%, but it's still really high compared to where we should be. Now, the dividend yield for the S&P is at 2.09%, and the 10-year Treasury is sitting at about 65.7 basis points. So the spread between the 10-year and the S&P dividend yield is a whopping 1.43%. So that means for passive index funds and other firms that just buy the index, buy the S&P, they're going to already have a 1.43% gain over the 10-year Treasury, which is considered a risk-free investment. So it continues to suggest that money wants to pour into the equity markets versus somewhere else. Now, if we just look at some of the sound bites this week, car factories are reopening, which in the great outdoors kind of beckons everybody, right? We've seen the death toll passing this week, 95,000 with about 1.5 million cases. The markets, though, as I showed, or as I just discussed, are just kind of remarkable strength. A lot of it kicked off on the positive news of Moderna with their vaccine drug. So that really helped out a pretty good little bit, right? So we're also seeing here, as I get these things a little bit mixed up on my chart, we're also going to see a very supportive Fed, all right? Boom Boom Powell, that would be Jerome Power Ranger Boom Boom Powell. He came out and he said that he still has a lot more tools to use if needed. So we're going to see that really helping out the markets here in the near term. We're also seeing, as I said, car factories open up in Detroit. We're seeing a lot more in PGA and NASCAR from sporting events, kind of staging these events without spectators. Major League Baseball is laying out their rules for upcoming pandemic play. So we're seeing folks starting to get out and about, and for those of you that are out running around, you probably noticed the traffic is a little bit more than it was a week ago or 2 weeks ago. But we did see this past week another 2.4 million people applying for unemployment, okay? And we're seeing a lot more people fall behind on their mortgage payments, but we're also seeing airline traffic up just a bit. All right. Now you'll see here I've got the S&P is kind of stuck between two competing forces. We've got the there's a bid under the market where there's about 6 trillion in central bank asset purchases, so that creates a nice bid underneath the market. But on the other hand, there's an offer out there, uh, given the 50% drop in global earnings through 2020. So far, though, the bid is winning, meaning there's more upside near term with this bank stimulus versus the 2020 earnings forecast of a 50% reduction. But just understand, and I'm going to show you in the charts in just one second, that if history is our guide, statistics usually work out. We're going to see the downside is more favored than the upside. All right, so we're going to see that come up. I mean, we're off of the market lows from March 23rd, but we're already seeing, according to a lot of brokerage firms, people are starting to get more into day trading. All right, and whether it's the fear of missing out, the FOMO, or the TINA, there is no alternative. Money is starting to chase returns over the past 7 weeks, and some analysts are viewing this as a little bit more speculative, bullish moves near term as day traders are starting to come in. All right, we're already seeing some of the pandemic stars like Netflix. It's up about 40% year to date. Clorox is up about 36% year to date. But a lot of analysts, as I said, I believe we've run too far too quick. And most of our members, for those of you that are members of our group, as you know, in early April, I was getting everybody long. I said, let's play this inevitable bounce that's going to happen. But I'm also calling for a little bit of a pullback here. I think the lows have already been made, and I'll show you why I say that. But I do believe we should see a risk to reward of 1 to 3 to the downside, meaning for every 1% move up, there's a 3x potential move down. So if you move up, let's say 2% from here, I think there's a 6% downside risk. Or if you move up 5%, there's a 15% downside risk. So I do believe the risk of the bigger move is to the downside as we see it right now. Okay. Also, looking at this thing, this threat has resurfaced. I mean, it's already been there with US and China with the COVID-19, but it's increased a little bit with China's move to put a tighter grip on Hong Kong. So that's going to heighten more of the tensions between what are already high tensions between us and China, or the US and China. It's kind of like the latest step to erode Hong Kong's autonomy under their originally agreed to one country, two systems framework. Remember, when Great Britain signed over Hong Kong to China, both parties were in agreement that they would leave Hong Kong's framework and their political system alone. They agreed to a one country, two systems framework. But now China is kind of backing out on that. So that's going to cause investor concern. And I think China, which seems to be oblivious right now to what everybody else thinks, probably not believing that Europe and the rest of the world is going to go along with a hard stance of the US against China. I think they're just kind of blustering forward. We'll see how all of that plays itself out. Okay. Also, as I said last week, hedge funds are moving out of some of the outperforming sectors. Like I told you, some of the stars in the sector were Clorox and Netflix. We're going to see probably companies now as folks are starting to get into this outdoor spirit. We're starting to see things like bike sales. I saw that was up over 400% in May. Hammock sales are up 150%. Boat sales up almost 100%. So yeah, folks are getting this outdoor spirit. And companies like Winnebago, WGO is the symbol for Winnebago, or Pool Corp, which is the symbol is POOL, Pool. They're up a good deal since last month. I think there's more upside to go there, as we're starting to see people come back. Some of those companies that really suffered the most are going to see some really interesting play out here. Okay, so that's a little bit about what I'm seeing here in these markets, and just kind of how things are rounding themselves out. Now, what I'd like to do here is just switch you over to another screen here. We're going to go just take a look at the charts here just 1 second. So I'm going to flip the screen on you. It's going to take a second or two to paint up on the screen here. as my WebEx does its thing and move around. Okay, but I'm getting this up on the screen for you guys as we speak. And what I'm going to show you here is a slide or a using eSignal's charting platform. I'm going to show you right now. You see an Ichimoku indicator on a 240-minute S&P 500 E-mini futures chart. And you can see on here, I've got a near-term resistance level around 29.84. We've come up and hit it once. We may come up and hit it again. And I have said that I would think over the next 4 weeks, there is a higher than likely probability that the market's going to have a nice little pullback. Okay, and I think the markets need that. It's going to pull back a little bit, and then once it does, it's going to allow some consolidation over the early summer months before we make another run as we go into Q3 and Q4. Remember, Q2 numbers, GDP numbers, are going to be Godsmack awful. But the markets already know that, guys. So there's not going to be a surprise there. Now, if they're worse than projected, then we get a little bit more downside. But depending on right now where we go with the summer months and the grand reopening experience of all 50 states, you're going to see some states do very well, others not do as well. But people are, I think, batshit crazy from being tied up, or let's call it batshit crazy politicians tying people up indoors. So people want to get out, especially with the summer months. So I think we're going to see that happen. And then whether we see a huge spike or just a normal spike in new cases, that's what's going to kind of govern where we're going to go near term in the markets. Okay, so you can see right here on this 240-minute chart, we've got a green cloud over here on the right hand side, which does suggest the markets want to be bullish at least up to the 3,000 level. Now if I switch over to a daily chart, you're going to see that I have called a potential hard stop right around 30.20. So that takes us over the 3,000 up here like this. You can see the Fibonacci extensions off the March 23rd lows right down here that were at 21.74. And the reason why I said the lows are in, I've said this last weekly roundup also, is that every bear market that we've had, going back about 70 or 80 years, every time we do a fib node extension off the lows and we go up around 55 to 60% extension off the lows, then we do have a pullback, but we never make new lows. If the fib extension price action took us up to 50% or less, then the odds favor a retest or making new lows, right? But in this case, as you can see on this chart here, this was the 61.8% fib extension off the lows, and we've been above it several times, right? And you can see here multiple days, 3 days where we've closed above the 61.8 fib node extension off the lows on March 23rd. That is my target right there. Excuse me, on near-term target of an Elliott Wave 3 count. And you can see here going out in time, I've got about a 2661 target, which would give us an Elliott Wave 4. And then moving up to make a higher Elliott Wave 5 as we move into Q2, Q3 towards the fall time into the end of the year. Excuse me, I swallowed my coffee wrong this morning. So that's what I'm looking at here. And you can see we hit my near-term target really nicely, these two circles here. They're designed and created with my charting package. However, they're drawn with a combination of Gann, time series, as well as Fibonacci extension series. So this is kind of what it's calling for, 2661. Now, you may have heard me say anywhere from 2600 up to about this level right here, 2750 or so, which is the 50% fib extension. It's exactly 50% from the highs up here and the lows here. Okay, so you can see we're well north of that 50% extension. Pulling back in here, I think, is a high probability, but taking out the 50%, coming back down, possibly testing the 38% fib extension off the lows, which would put us at 2641, to me make a lot of sense. Okay. Now we've got trades in place that should do very well down here. In fact, I've got trades in place that if we come down even lower are going to be home run trades, and yet allows us to make money to the upside as well. So we're going to be watching this really closely as we move forward into the month of June as the summer months really start to kick in. Okay. So this is a little bit about what we're seeing. Now this solid dark or this solid green line here is the trend line that goes all the way back to March 9th, 2009 lows. You can see here as we move forward in time, it's a gradual progression moving up. And we could come all the way back down to the 2500 to the 2550 area and still maintain our secular bull market. Okay, now you could see we blew below it here, but we quickly regained it, but it's starting to show signs of fatigue by coming in and hitting it and going below and then coming back up again. Okay, Chart is starting to show this. Now, if I were to come back to, if I were to put it on a weekly chart, for example, and just kind of step out a little bit, you can see here back in December 24th lows, we didn't quite fall below the trend line here. Here we did. But you can see this rapid move up right here on this weekly chart. I don't believe it's going to be a V bottom, which would mean we come down like this, and then we just pretty much with minor dips come back up, giving us a V bottom. I don't see that happening. Right now, the odds basically still favor probably more of a W type bottom where we're down, we're up, we have a little bit of a move down here, we find a support area, and then we come back up like this, and then we go like that. So that gives us our W bottom like that, and then creates a new channel back to the upside as we go through Q4 of this year into Q1 of next year. That would be the favored move. Okay, I don't see us making new lows at this point in time. But be that as it may, as you guys know, anything can happen in these markets. But that's what I'm looking at right now on these charts here, especially on this daily chart here with the fib node extensions and kind of where we're seeing. Now notice the 200 SMA right here. This is an SMA, not an EMA. I know many of you have written to me and said, well, it says we're over the 200 moving average, but on my chart it shows I'm under the 200 moving average. Well, you got to determine whether you're using an SMA or an EMA. The algos use both, by the way. You can see here the 200 SMA is sitting right around 29.96, so just slightly under the 3,000 mark. The 50 SMA has already started the curve higher, is starting to move higher. So the price action is stuck, and this is going to be a huge nut to climb over. We need a catalyst to move over the 200 and get enough momentum to hold it and continue to build this with support. Okay. Now, if I switch the screen, what I'm going to do is I'm going to take you over to the same chart, but now I've switched it to the EMAs, exponential moving average versus simple moving average. And you'll see the difference between the two. So on this chart here, when it paints on the screen for you guys, you're going to see that I've got, again, the same two lines, yellow and red, the yellow being the 200 EMA and the red being the 50 EMA, but now we're using the exponential moving average. You can see here we're clearly over the 200 EMA and we're above the 50 EMA. And if I were to blow it up just a little bit more to get you a little bit more clarity on the screen so you can see it better, you can see that looks like on a daily chart a hammer. A hammer is more of a bullish pattern than a bearish pattern, which would suggest we're going to come up and go back to my near-term target of around 30.20. We're going to bust through the 3,000, maybe come up to that area there. But keep in mind, I'm also over the next 4 to 6 weeks, there's a higher probability of moving down to the 2650, 2750 range, as I showed you on the other E-mini chart for the S&P futures. So that's kind of what we're sitting at right now. Now, if we come over and look at NASDAQ, oh, by the way, I mean, if we were to back out again, you can see how far below the closing price of 2019 we are for the E-minis. All right, we're above of the S&P E-minis. We're above the 200 right now EMA, but we're still well below the closing price of 2019. If we look at Nasdaq, it's a little bit of a different picture. You can see here the 50 SMA is above the 200 SMA very nicely. We're above the closing price of 2019. So we're in the green, as I said earlier, for the year. We're near the 2020 all-time highs for NASDAQ. Okay, NASDAQ has just been, this stay at home has, I think, accelerated anywhere from 3 to 5 years the transition to more technology oriented workspace, especially with the work at home. And for our members next week, this Sunday, and this a Memorial Day weekend, and we want to remember all of our veterans who gave their lives for the U.S. military. But it's going to be our next session is going to be next week for our members. We'll go through some really good plays here that I think are going to be really strong performers, particularly after this next downdraft that I think we're going to see. Okay. Now, if we look at the Russell is bringing up the rear. You can see here the Russell is above the 50 SMA, but below the 200. And look, here is the 2019 close for the Russell, right? Well below here. So it's probably the worst performer. But as I said, this past week, it outperformed the other indexes almost double. So it's going to play a little bit of catch up. There are some ways to play that move that I think that are going to be very profitable for everybody and for our members. If we look at the volatility, you can see on volatility here. Now I color code the vol chart, and it's for a reason. Depending on where you are on this vol chart, different option strategies makes more sense because volatility has the most impact on option strategies, almost to the factor of 10x compared to just simple theta or premium decay, right? You can see here we've labeled the zone 1 through zone 5, which is black swan up here, right? And you can see based on where we are in this zone are the strategies that we deploy, and it just makes sense, right? And most beginner and even some intermediate traders don't understand Vega. They don't understand weighted Vega, nor do they understand some of the higher order Greeks associated with volatility. So you just have to be really cognizant of how this thing works to take advantage of volatility in this market and understand, even though we've come down dramatically from our highs that we made here back on the 18th of March, we're still in the kind of pink to rose, slightly not quite red zone. We're still elevated. We're at 28.16, and it takes longer than normal to come back and normalize the skew in volatility when we go this high. Now let's look at the skew. If we look at the front month volatility skew, which is the VIX compared to the June contracts, you can see we're in the green. So this tells us that we are in a normalized skew, but just barely. We're towards the top of it, but we're in what's called a contango environment for vol skew. So we're starting to normalize. Now, if we go look at the back month skew, you can see right here, we're still in the red. So the further out in time we go, and this back month skew is the July August vol skew, and we're in a backwardation. So that means that as we go towards the tail end of the summer, which is, if you think about it, when we start to get Q2 data, Q2 GDP data and everything else, then that is showing a lot more fear out there than the front month. So that's why the front month skew, I still see a little bit more near side as this FOMO trade continues to wear on. And ideally, we'll see more rat brain traders just load up the barrel here. And then as everybody switches over to the bullish camp is when we're more active in just assuming a contrarian view, and we'll take the other side of the trade. Okay, and then 75–80% of the time we'll do very nicely. So for our members, just buckle up, seatbelts on, seat backs in the upright condition, tray table stowed, and let's just get ready for something like that. Now, if it doesn't happen, we've got some bullish trades on that'll still allow us to make money. But I think the bigger money is going to be made over the next 4 to 6 weeks and a possible downdraft. Okay. Now, if we look at treasuries, we look at the bond market, you're going to see here the bond market has basically been flat. I mean, you can see this yellow bar here, which is the greatest amount of volume has taken place at this price, and we're sitting on it right now. I mean, we haven't really gone anywhere. We're sitting right on this level here. So up or down, I don't see a catalyst that's going to move bonds. The central banks have stepped in globally, all central banks, from the Bank of England to the ECB to the Bank of Japan to the US Feds, they're all buying, and they're just adding massive amounts of stimulus to the markets. That'll only work so long, and then that's gonna start to come undone here. But you're going to see here that we're going to kind of a little bit of a sideways motion here. If we get up in this area up here a little bit higher, I'll be more than willing to sell than be a buyer of the bond market. Okay, and then by the same token, if we look at the 10-year interest rate, you'll see it's just off the bottoms, but really hadn't gone anywhere. It's near the value area here around 63 basis points. So I don't see a catalyst that's going to move it up or down um, over the next 30 days. Okay, that's kind of where we're sitting right now. In fact, you can see the Fed Fund Futures is forecasting negative interest rates next year. And while Jerome Power Ranger Boom Boom Powell has said he's not going to see negative rates, the markets are going to dictate it. But those negative rates are not longer term, they're more short term. So we're going to watch for this and just see how this thing plays itself out. It will be interesting, folks. I can guarantee you that. US dollar, remember, it's a dollar index, so it's not really the dollar as much as it's where are the other currencies in relation to the dollar. And the dollar has been bullish for quite some time. This big move here was just a result of the massive sell-off that we had in March and everybody racing to the dollar, which shows the dollar is still a flight to quality or a safety. Dollar got too expensive, so the Feds came in internationally and did a reverse repo where they were selling dollars to get it back down again because they were running out of dollars internationally. Banks are required to own a certain amount of dollars. Global banks, not U.S. banks, banks in Europe, banks across Europe, Great Britain, everywhere. They're all required to own a certain amount of U.S. dollars. And everybody wanted to buy dollars and no one wanted to sell their dollars when the market started crashing and the dollar got too strong. So the Feds had to come in because there was a run on US dollars. Feds had to come in and do that reverse repo by selling dollars in the global markets, and you can see it came right back down again. But longer term, if I were to back this out, you can see the regression channel here on this daily chart coming all the way back on the left-hand side of the screen, the summer months of 2018. It's very clear where the dollar's been going, and we've been just riding, give or take, up above or below the mean. The mean of the regression channel is right in the center, and I don't see that changing near term. As long as there's a lot of this fear in the markets, you're going to see people, when I say people, I mean central banks globally, wanting to own the US dollar, which means they are selling their currencies and then trading them in, swapping them in for the dollar. Okay, so that's what I see. And then let's just look at the euro. The euro accounts for about 57.6% of the dollar. And you can see this trend line right here. The nice thing about currencies, for those of you that trade currencies, it tends to trend. So looking at January of 2019, you can see the center line of this regression channel. We're just, give or take up and down, we're just moving down this regression channel, right? We're off the 2020 lows of 1.06 euros to the dollar. I wish we could travel to Europe and travel around and take advantage of the strong dollar, but travel right now internationally is very difficult. Yeah, I just don't want to risk it right now. I normally spend a couple of months a year in Europe, going across Europe with seminars and things like that. But I'm staying put right now until we can get all this stuff figured out. But you can see the euro is down, and then of course if we look at the British pound, I didn't put this on here, but I could just as easily put a regression channel on the British pound right here, and you could see this move here. Now in this British pound on this daily chart, when we had this big sell-off here, I was telling our members we got to go long the British pound. I mean, this British pound was down to $1.14 to $1. I mean, folks, you've got to take the contrarian approach on this and be a buyer. And we were down in this level here, and we just took a nice quick low-hanging fruit off the apple tree, bite out of it and just let it ride up real quick and then just take some quick profits. But that's kind of what I was looking at on the British pound. And then of course, if we look at the Japanese yen, you can see here, like the US dollar, the Japanese yen is a flight to safety, always has been. And you can see the yen just screaming up. And then when Boom Boom Powell did his thing, started selling dollars internationally, then away we go. Yen came back down also. And the yen, by the way, accounts for only about 13.6% of the US dollar. But it's rare that you see both the dollar and the yen come up. But when Powell started doing what he needed to do, you can see here in the month of March, which was really where the big fall off happened, you can see money coming out of the yen right here, which is unusual. But the dollar was where everybody wanted to be, and they still holding dollars. So the Feds are still into their repo actions in the U.S. to support liquidity, and then reverse repo internationally to support people holding U.S. dollars. Really crazy. Of course, if we look at gold right here, get gold up on the chart, is doing kind of what I said. We're in this tight range from 2020 highs down to the 1674. I'm not doing anything in gold right now. I think near term gold is just going to still be choppy. It's a day trader's market, and gold, for those of you day traders, are just short 1 or 2 day swing. I do believe in the next couple of years, gold is going to be back up over 1900 an ounce, possibly even approaching 2000, but that's in 2022, 2023. I'm forecasting, and there's going to be a huge opportunity at that point in time for the markets, because we're going to see a big downdraft to the tune of 50 to 65% move lower in the S&P and the Dow. Yeah, you heard me. 50 to 65%, but that's not out till 2022, 2023 timeframe. And that's when gold is going to take off, right? And we're going to see inflation start to take off, and all sorts of things are going to break loose at that point in time. Right now, gold is just a chop, so I'm not really into that. If we look at copper, because copper is another one, we got in when it was down low right here, right? I had our members jumping in low with copper. We made some money on this move here. I think near term copper can go up a little bit as the economy starts to come back together again, because copper has been called Dr. Copper. China is the biggest buyer of copper. Industrials, generally when you see the markets start to get stronger coming out of a recession or something like we got, industrials do better. Copper, building supply stuff does better. So we'll see that. But our go-to trade, as I've suggested to our members, has been silver. It, on average, it takes about 60 ounces of silver to buy 1 ounce of gold. But lately, it's been about 105 to 110 ounces of silver to buy gold. So silver was undervalued. And I said, if you're going to go long a precious metal, make it silver. Now, we did this trade again about a year ago. We did very well. It got out of whack again, so silver was the go-to trade rather than gold. And as you can see, it's just near term, it's outperformed gold really nicely. There are other ways to play it for our members we'll talk about next week. Now, the other thing is, let's take a look at the oil markets. The oil markets, as you can see here, had a really great week. Percentage wise, I've got the zero rate capped here. I don't think we're going to see that again. It was an anomaly for the May contract with storage, but there's been so much cutting in production from the Saudis and the OPEC plus Russia. I think the report came out saying that 96% compliance, which is really unusual, but they're all compliant. They're cutting production. And the shale producers here in the U.S. have cut over 2.1 million barrels a day, which is unheard of. We haven't seen cuts like that since 2016. Right, 4 years ago. So what's going to happen is going to be like the tail whipping the donkey, because you're going to see so much cuts that eventually they're going to work off this excess supply over the next 3 to 6 months, and then you're going to see a spike the other way with oil. So there's a way to play the oil market, guys, and if you do it the wrong way, you're going to lose money. So for our members, I'll show you that. I've talked about it before. We're in oil right now. We're playing it to the upside. So you just have to understand how to play it. Okay, because there's a right way and a wrong way to do this. And if you do it the wrong way, then you're not going to make what you should make in the oil markets. All right, everybody. For those of you Americans out there, I hope you have a really great Memorial Day weekend. Enjoy the extra day off. For everybody else, I hope you guys are having a good weekend. Remember, the U.S. markets will be closed on Monday, so it's a holiday for U.S. markets. So it'll be a relatively quiet day, but most markets are open except for the U.S. And we will see everybody next week. If you're not a member of our group, I highly encourage you to come in and check us out. We've got a Memorial Day holiday special that you can take advantage of. Have a great weekend, everybody. Take care, folks. Ciao now.